Welcome to Stock Time to Improv. I'm Mary Scott with Business Riff, and I want startups to be wildly successful. Today, we're going to be talking about a brand new way of funding startups with our special guest, Daniella Tedesco from
Los
Next
Angeles.
Round.
Yep.
Next Round. Thanks so much for coming, Daniela.
Thank you for having me.
So let's jump right in. This has to do with philanthropy, right?
Yes, it's a new
And
way of funding startups using philanthropy money.
so we've heard of cause-based marketing. This is cause-based funding, right?
Yes.
Sounds good. So tell us more about it.
Sure. So I think right now the current funding landscape is becoming very difficult for early stage founders. As many of people probably listening to this podcast know, the current environment around early stage investing is that you pitch to an investor and they say, oh, you're too early, or especially in life science, let us know when you get to, let's say, phase two data. Those are unattainable without capital. And we run a firm called Next Round AI. It's connected to Next Round Philanthropy. Next Round AI initially works to find investors for startups that are in need of funding. We pitch on their behalf, and we hope to try to bridge the gap of communication between teams that are incredibly competent and have an incredible product, but might need help on more of the financial side and talking finance to finance. So we help bridge that gap. But it kind of happened where along the way we realized that these conversations were happening. And then that's where we founded Next Round Philanthropy, which creates a way to make early stage investing tax deductible. And it's through a donor advised fund model.
Wow, that is really impressive. So what kind of donors have been coming on board for this at this point?
So there's three different donors that would be interested in this model, and I'll explain, and this is a way that it might be helpful for those seeking funding. And there are mechanics within the donor advised model that are on our website that pretty much explain that we partnered with a donor advised fund that is able to take illiquid securities. You donate to the donor advised fund and then tell them to donate to a startup. And the partner that we partner with actually also does this for the Yale Endowment and the Columbia Endowment, so they are reputable. But the three types of donors that we try to attract are one, you donate to charity, say 50 cents on the dollar or some amount that's not the full 100%, don't actually go to the cause. And the person who donates is upset. They would rather have 100% of their money go towards research in a in the field. So our way is to say, hey, if you're about to donate to charity, put your money in a donor advised fund and instruct the donor advised fund to invest in this company that you care about. The second is for that investor in the beginning that we talked about that said, no, you're too early, and gave a bunch of different reasons why. Mr. Investor probably donates to charity, given that they are still in the finance world and because they need a tax write-off. So that's when we would say, hey, this is a way for you to de-risk your investment. Use the donor advised fund model, and instead of donating to charity, donate to the portfolio companies of impactful startups that you're funding. So this is for angel investors or even institutional investors. The third one is for someone who just had a liquidity event. Especially in the startup landscape, there's lots of liquidity events, and there's people who come into new generational wealth and they'd like a new way to manage it. So this funding process helps them start their journey, and it's with annual giving where they donate to these startups. The last thing I will mention is that because it's a donated investment, the donation is actually turned into equity because it's an investment, and all that equity goes to charity. So this is a model where there's no other way out there other than this traditional way of venture capital investing where you're able to make a return. And our thought process is that we'd rather have the impact go back to a charity or the cause rather than Wall Street. So this is a great way to bridge that gap.
This is really, really nice because it almost, from the startup's perspective, they don't have to pay this back.
No, they do not.
And from the investor's perspective, it's a tax deduction. It's a way of seeing if something's gonna float out there. That sounds really, really good. So what are some of the industries in particular that can benefit from this?
So if there's a way that you can try to connect impact to the work that you're doing, that's primarily who we work with. I know that there's millions of companies out there that can probably from tech to, computer science that can connect it, but primarily as we're getting started because our company is still it's close to a year old. So we have traction and we have validation, but we're still working to find a big network of donors. And it's a lot easier to work in the life science space and the climate tech space because current administrative grants are being cut in those industries. So we're trying to fill that gap with the current fundraising model. So my answer to that would be anything in the life science space, medical tech companies, pharma companies, as well as climate tech companies, clean tech companies, and even educational tech companies that would need to bridge that gap. Companies where the investor says, "We love you for this, XYZ," but and then right when you hear that but, that's probably where we would have the best impact if you come to us.
Okay, would this include alternative energy companies?
It would, yes. So I think there's so many different categories within the environmental space, but to be broad, let's just say, the life science space broadly and then the climate space broadly. Typically, we focus on seed to Series B. If there's pre-seed with traction and we know that we'll be able to find them an investor down the line, that's also what we work with because we pre-vet on the investor side saying, hey, if they have the capability to have those "we love you" conversations and someone is interested down the line, then we do believe it's appropriate to market them on the philanthropy side because then once they get through the philanthropy side, they can go up to institutional money. We're helping them bridge the gap so they don't have to be fully funded through philanthropy, but it's from the beginning.
Okay, how big are the grants coming in?
Right now it says within the $1 million range, but we can go up to any amount. We can go from small amount to, $100,000 to the $1 million range. The donor advised fund has $1 million minimum. So we're hoping to work with high net worth individuals. The smaller range, we do a similar aspect, but we would partner with a nonprofit, and that's a way that we would instigate it there that way, and the equity would go to the nonprofit. But the way that we actually are compensated is that we receive equity in the company that we find funding. So we want to take the same risk as you, the founder, and the investor and the donor, because we believe that the cause we should get paid when the founders get paid.
Okay, so I'm thinking that some of the institutional investors should consider you as part of their portfolio, right?
Yes.
This is really fascinating stuff, and I can't wait to hear more about it. So we will put some contact information and links in the comments so people can get in touch with you and find out more about this great new way of cause-based funding. Thanks so much, Daniella Tedesco from Next Round Philanthropy.
Thank you very much for having me.
And I'm Mary Scott with Business Riff. I want startups to be wildly successful. And one of the best things you can do to accomplish that is book a call with me at businessriff.com. And join us again next time for Stuck Time to Improv.